There is no sugarcoating it. The last several weeks have been a nightmare for many investors. Trump's tariff plans have changed day to day, with the stock market bearing this uncertainty. It's left many people wondering what's the end goal here for the US and President Trump. Well, despite what many people may think, Trump does have a plan here, and if it's executed properly, it could benefit the US in several ways long term. There's four key drivers behind Trump's tariff plan: policy change, leveling the playing field, generating revenue, and protecting domestic companies. Each of these four pieces build the structure of Trump's overall strategy when it comes to imposing tariffs. So first, policy change. Tariffs can be used as a negotiating tool where one country with economic leverage uses it to effect policy changes. For example, immigration, drugs, etc. This is a big driver behind the tariffs specifically aimed at Canada and Mexico. The Trump administration has called on these countries to curtail the anything-goes lax border controls on immigrant traffic and the flow of drugs into the United States. And tariffs are being used as a tool to enact these changes. The second reason, to level the playing field for US exports and reduce the trade deficit. This has been the main cover story behind these tariffs. And there's some truth to it. The US ran a deficit of about $123 billion back in February, and the global tariff structure has been quite uneven for the US for quite some time. When it comes to leveling the playing field, automotive trade is a great example of this. US automobiles exported to Europe are subject to duties in excess of 10%, while European automobile exports to the US are taxed at 2.5%. However, the formula used to come up with the country-by-country tariffs on Liberation Day correlates more to the absolute level of trade deficits with countries and are a bit of a head-scratcher. For instance, some countries with whom the US runs a trade surplus, such as the Netherlands, Brazil, and the UK, have been slapped with tariffs, leading us to believe there is some basis for the third reason, which is to generate revenue for the US Treasury. The Trump-inspired, Republican-sponsored Big Beautiful Spending Bill talks about imposing a universal 20% tariff on all imports. The stark reality is that the Tax Cuts and Jobs Act 2017 sunsets at the end of 2025, and almost two-thirds of taxpayers could see their tax bills rise. There is a high level of urgency to get this legislation renewed. On the other hand, both parties in Congress and the White House have ambitious tax reduction and spending plans, but little will to enact spending cuts. There is a growing belief in some circles that the savings from the Department of Government Efficiency, aka DOGE, and the revenues from increased tariffs are needed to appease the fiscal hawks in Congress to gain support to renew the Tax Cuts and Jobs Act of 2017. The final reason is to protect domestic companies from foreign competition. This especially applies to neo-colonizers such as China. China has an abysmal track record of a wanton lack of respect for intellectual property, bare-knuckle business practices that place US exports at a disadvantage to help its domestic companies. On the other hand, supporters of free trade would argue that protecting weak domestic industries by the use of tariffs creates inefficiencies, such as those seen in socialist countries. Think about this. Is it more efficient for the US to make sneakers and Vietnam sophisticated airliners? It's a concept called competitive advantage and naturally favors some countries in some industries while making others less competitive. As we see it, national security considerations and protection of intellectual property are to some extent behind the tariffs on China. While tariffs such as the 20% Smoot-Hawley tariffs imposed in 1930 evoke fears of a Great Depression-like scenario, it is important to understand that the fallout from the Smoot-Hawley tariffs was exacerbated due to policy mistakes by the central bank, failures of big banks, financial institutions, and a rigid economic and monetary system tied to the gold standard. The economic system is far more transparent and flexible now, and central bankers more experienced at dealing with economic cycles, and financial institutions far better capitalized. And the US has the clear economic dominance in these tariff battles. US exports in aggregate account for 11% of its GDP, while consumer spending accounts for almost 70% of US GDP. While US exports only 1.8% of its GDP to Canada and Mexico, Canada exports to the US account for 19.5% of its GDP, and Mexican exports account for 25.3% of its GDP. The auto industry stands to be most negatively impacted in a trade war with Canada and Mexico because much of its supply chain and manufacturing capacity is in Canada and Mexico. These are covered by the USMCA treaty, interestingly signed during Trump's first term. And the US would have to provide legal evidence of abuse to slap on sustainable levies. There has been much concern over a brewing trade war with China, but the US also has the upper hand here. China accounts for only 6% of US exports and accounts for less than 1% of US GDP. On the flip side, though, Chinese exports to the US account for about 3.5% of its GDP, so China would have more to lose in an all-out trade war. However, agricultural and farm products such as soybean and pork account for the largest piece of US exports to China, and retaliatory tariffs will likely hurt Midwestern and Great Plains states like Iowa, Nebraska, North and South Dakota, and Kansas the most. At some point, though, China is going to feel the pressure, since tariffs will create domestic inflation via these two staple sources of nutrition, and they will likely be motivated to come to the negotiating table. Many US consumers and investors feel that there will be a one-for-one relationship between tariffs and inflation. That is not necessarily the case. Sometimes businesses choose not to pass through price increases in an effort to maintain sales volume in a competitive environment. The consumer retail industry is most likely to be negatively impacted by a trade war with China and will feel the pressure on its margins. On the other hand, low-price competition from Chinese retailers such as Temu and Shein has been held off as President Trump has removed the de minimis exemption that allowed these companies to ship directly to US consumers without paying duties. Markets abhor uncertainty, as we have seen recently in the short run, but in the long run, earnings growth and valuations have a greater influence. If done right, using tariffs as a tool for policy change could have marked positive outcomes, such as reduced spending on drug and border controls. Fairer reciprocal tariff arrangements could level the playing field for US companies as exports. While the current rhetoric and market downturn are understandably jarring to many Americans, remember that the US has clear economic, geopolitical, and policy leverage here. Also, before investors get too bearish and bail out of the markets, it is important to point out that the gloomy mood of investors could shift on a proverbial dime. All it needs is some resolution and prospective agreement on tariffs. Despite the harsh rhetoric from China and Canada, most other countries have willingness to negotiate with the US. And while the Fed has so far articulated a wait-and-see approach to monetary policy, they could step in with a rate cut if things get really bad. Markets could rally strongly on that development. Paraphrasing the famous Fidelity portfolio manager Peter Lynch, when things go from terrible to semi-terrible, you can make a lot of money. The current market volatility could benefit many investors long-term if they play their cards right. As always, patience is a virtue, and facts and reason triumph over irrational fears and sentiment. Thank you for listening.